Today on Your Money, Your Wealth, we're back for round 3 of the YMYW Retirement Plan Spitball Analysis. And this time, Joe and Big Al focus on your tax diversification and asset allocation questions. Should more money be going into Christy's pre-tax Roth accounts? Has Roger set up a good asset allocation for his elderly relative? Plus, find out what the fellas think of the Rule of 100 or the Rule of 120 for investing in stocks and bonds, as touted by Jack Bogle and the Bogleheads. Also, should Tom take a coronavirus-related distribution? And finally, the fellas answer your questions on when to take Social Security and that file and suspend rule that affects people born in 1954. Click the link in the description of today's episode in your podcast app to go to the show notes, read the transcript, access this week's free financial resources, and send in your money questions. I'm producer Andy Last, and here are the hosts of Your Money, Your Wealth, Joe Anderson, CFP, and Big Al Clopine, CPA.
Alan Christy from Seattle writes this. This is an essay. It's an essay, I think is what Christy from Seattle.
We love your emails. If you could make them a little more brief, that would be cool.
That means they're going to cut out all the compliments and flattery.
Oh, okay.
Well,
yeah, you've heard me try to read these things.
True.
It's awful.
I think that's partly what they like, though.
It's awful. If anyone
That's
likes
why
that,
they make them long.
It's so bad.
They want to see how you're going to pronounce certain words.
Yeah, just fumbling around like. Anyway, hi, Big Al, Andy, and Joe. Okay, first of all, so I'm last billing here.
She's maybe a Big Al fan, maybe. I don't know.
She is a Big Al fan. Big fan of the show, especially when you praised my comments on Solo 401k a while back, podcast 194. I have a question about your favorite topic, Roth retirement accounts. It's not our favorite topic, Christy. I'm so sick and bored of talking about Roths. You cannot
at least
imagine.
She didn't say backdoor Roth. That would have been it. Would have stopped her.
No killer. Oh, God. But we're doing our duty to answer your guys' questions. I have a question. Okay, so it's the show's. It's your show. It's your favorite topics. It sounds like. Okay, my husband, 52, and I, 46, are planning to retire when he's 60. Right now, we have about $450,000 in a taxable brokerage account, mostly in low dividend index funds in individual stocks. $900,000 in IRAs, 401ks, $130,000 in Roths, $50K in an HSA, and $120,000 in cash. Part of which we're hoping to use for a down payment on investment property soon. That means less than 10% of our retirement assets are in Roth accounts. This is because we have a relatively high combined income of about $400,000 per year, which puts us in the 32% tax bracket. And so it hasn't seemed to make much sense to put money into Roths. Right now, we're saving about $160,000 a year, with about 1/10 of that going into Roth via my husband's 401k, which allows post-tax contributions that are set up immediately to roll into the Roth. Oh, there you go. Congratulations there. That's the mega backdoor.
That's it.
There, Big Al.
Right.
So I knew it was coming. Every email has something to do with the back door. Just call it backdoor planning. Right. We have about $100K a year into a tax. We save about $100,000 a year into the taxable brokerage account, mostly because a big chunk of my husband's pay comes from RSUs. We also have about $500,000 of equity in our home. We're hoping to have about $4 million in total savings 8 years from now, which I project will break down to about 40% taxable accounts, 50% traditional retirement accounts, 10% Roth. Then we plan to live mostly off our taxable accounts in some rental property income, hoping to spend about $160,000 a year through retirement. So looking to do Roth conversions for the first 10 years of retirement, then we'd switch to living off a combination of traditional and Roth retirement accounts plus Social Security. Is there a question anytime soon here, Christy? The question is, okay, thank you. Is this a good plan? Yes, it's a wonderful plan. Will it give us enough tax diversification in retirement? Given the capital gains taxes are lower than the tax brackets we plan to be in retirement, is it okay to keep putting as much into the taxable accounts? Or should we divert some of the taxable accounts to minimize post-tax contributions, beef up the Roth before we retire? I like the liquidity and flexibility of taxable accounts, and I'm reluctant to take money out of them during the next few years since they're mostly in stocks, which means we have a high average rate of return, but they're volatile. Am I wrong to rely so heavily on taxable accounts in the retirement plan at the expense of Roth contributions? So, no, I mean, I think she's on point. They're still gonna have a couple $1,000,000 in retirement accounts when they retire. So I would here's the rules. This is what I would do. They're saving $160,000 a year, Al, which is a significant amount of money compared to most Americans. So Christy, so if your husband's going with the Roth 401k, what the hell? Go Roth 401k. Do the after-tax contributions to the max. So that's about $54,000 that you could put there, and then convert that into the Roth. If you have a 401k, max out the 401k plan. If you haven't done backdoor Roths, do backdoor Roths of another $7,000 a piece. And then everything else goes in the brokerage account. What do you think, Al?
Good. Except she mentioned she's got 401ks and IRAs. So if they already have IRAs, the backdoor Roth will be more problematic because of the aggregation rule and the
then put it in the 401k.
Yeah, if you can roll your IRAs into the 401k, it opens up the ability to do the backdoor Roth. But yeah, I agree. I think it's a great plan. I think, Christy, you're in a high tax bracket right now, so the tax deduction is particularly valuable. And then in retirement, you'll likely be in a lower bracket. Looks like your husband will retire at age 60, so there's 12 years to convert, and you're even a little bit younger. So there's a lot of years to convert, and while you're in low tax brackets. So yeah, I think it's a great plan.
Yeah. So, right, they're using the trough, have that low income, convert up to the 10, 12% tax bracket. You got 10 years to do it. They're living off the brokerage accounts. That's going to be capital gains. Their RMDs at that point is going to be pretty low, right? Because a lot of it's in the Roth. The Roth doesn't have an RMD. The Social Security, push that out to 70, right? The provisional income on the income for Social Security, it doesn't include Roth distributions. So they could potentially be in a 0% tax bracket in retirement if they do this right. So great job, Christy. Thank you very much for the email. Roger writes in from San Diego. Hi, Andy, Alan, Joe. Oh, and sure, Joe, too. God, this is like 3 in a row.
They're doing your trick. They're figuring out the thing that bugs you, and they're using it against you.
They seem to like to do that, don't they?
I guess so. It's very funny. Thanks for all you do and a great show. All right, so I'm tasked with helping an elderly relative handle their money. But first, let's go through the most important info. I drive a 2009 Altima. I don't have a pet, but I love dogs. Altima. I'm trying to figure out. Nissan
Yeah.
Altima. That looks like a Camry. Yes?
Maybe.
No? Maybe?
Similar, yeah. I think so.
Yeah. Affordable, but
I think
kind
it's
of
maybe
sleek.
not as big as a Camry, although I could be wrong.
Okay. He loves dogs, but doesn't really want to rescue one, sounds like.
I love them, but I don't want one.
Okay, the relative doesn't drive or have a pet. The relative is 89 with excellent longevity and health, and we're hoping we'll be around at least 10 more years. Wow, that's age 100.
Yeah.
After spending their pension and Social Security, they spend about 3% of their portfolio a year and don't have a desire to spend more. They live in an independent living assisted facility, all meals included, but don't currently need assisted living. Obviously, when they need assisted living in long-term care, their spending will go up. Now, their heirs are all financially stable and don't mind that the portfolio is spent down. I've set up an allocation for them that is currently 33% S&P, 46% bonds, and 21% cash. I think odds are good that they won't ever spend the money in stocks, and about 30% of the stock value is unrealized capital gains. Their current income is in the 22% federal tax bracket. They live in California, so I'm thinking let the stocks go to their heirs. There's a revocable trust to get the step up in basis. Total estate is well below the state tax exemption. The biggest dilemma that Roger's got here is what to do for bonds and cash. Right now, I have them in short-term and medium-term bond index funds and laddered 1 to 2 year CDs. I know fixed income right now is just horrible, but I wonder if I'm missing something. I've considered munis, but given the COVID recession, I think there might be more risk than usual. I've also looked at a 3-year a guaranteed annuity, but I don't know that the interest difference is worth a hassle. I agree with that. I could take some of the bond money and put it into preferreds, but that would also expose more portfolio to stocks. I'd love to hear your thoughts on the allocation as well as what to do with the bond cash allocation. Obviously, your comments will only be taken as entertainment value, so feel free to entertain away. All right, so Roger's living in the world that we all live in, is that he can't find yield in fixed income.
Yep, that's very true right now.
So he's like, okay, well, I got 33% S&P 500. We're not going to sell the stocks. We got unrealized capital gains. They're only taking they're taking 2 or 3% from the portfolio. A lot of money in bonds and cash, and it's like, hey, the yield on this is dog doo-doo. Yeah. I mean, welcome to the world we live in with very low interest rates. Is there something else that, like, if he goes preferreds, MLPs, I mean, there's all sorts of way that you could create income with a higher yield, but he just said it himself. He's like, okay, if I try to get a higher yield, what's going to happen? He's going to take on more risk. And you could go into high yield bonds or preferreds, but they act almost like stocks in a downturn. So if you're willing to try to get the upside, but are willing to take the downside, well, then by all means. But just understand the risk and return relationship of whatever investment decision that you have. Cash and short-term bonds is the riskless asset. That's why you're not getting any return on it. But it's going to be your buffer when the market corrects.
Yeah, that's exactly right. And I think that, to me, the allocation is probably pretty close. I might have a little bit less in cash just because bonds pay more than cash. Right. And earlier this year, when the market went down, we got some good returns in bonds. And that's what the whole point of bonds is. They help buffer the stock market. But I would, on the stock side, I would probably go Wilshire 5000 or total stock return instead of just the big boys, the S&P 500. And I would maybe I would do a quarter of that or 33% of the stock portfolio in international, maybe a total international fund, just to get a little bit more exposure that way. But there's not a lot of return in bonds, but it's better than cash.
Yeah, I mean, he's got 70% that's not yielding anything. So as a total return portfolio, it's like, man, this thing is probably getting me 1 or 2%, 3% total return because the bonds are flat, sometimes negative yields, and the S&P is doing its thing. Well, the S&P is at all-time high, so you want to maybe have a little bit more stocks, but break it up, Al. I agree. Maybe have a little bit more international emerging market exposure. That's going to give you more return in the overall portfolio. So if they're only going to spend for the next 10 years 3% of the portfolio, I mean, yeah, maybe you have 15% in cash and have them spend on the cash, and then you can take on more risk in the other portfolio. That's going to go to the heirs. If there's a long-term care need, right? Well, you still got a lot of the portfolio in fixed income. So I think he's doing the right thing. He could probably get a little bit more creative, but it all really depends on the life of his buddy or the relative when he needs more cash. Because if he's just taking 3%, he's got enough in cash. He's got a 10-year time frame. I mean, I think he's on track. I wish there was a silver bullet to say, hey, try this ticker or try this, or when it comes to safety, there's a relationship there with the return, and low risk means low or no return in this environment.
Are you confused on the concept of asset allocation? In the podcast show notes at yourmoneyyourwealth.com, I've posted a blog, a video, and a previous podcast episode on what asset allocation is, how it differs from asset location, and what the right asset allocation is for your retirement to help you get up to speed. If you have a question about an appropriate asset allocation for your retirement investment portfolio, click Ask Joe and Al on air there in the podcast show notes, or sign up for a free financial assessment for a deeper one-on-one dive with a certified financial planner professional. Whether you read a blog post, ask a question, or get a financial assessment, it's all free, so you cannot go wrong. Click the link in the description of today's episode in your podcast app, go to the show notes, and avail yourself of all this valuable free stuff. And don't forget to share it with your friends.
Keith writes in, Alan, Okay. I'm trying to see if the late Jack Bogle's age-related stocks versus bonds holds true to your opinion today. The theory is my age, 60 years old, percentage in bonds, and the remaining 40% in stocks. I don't think that's Jack Bogle, Keith. Isn't that your age minus 100?
Yeah, and then they because that didn't work, they changed it to 120. Minus your age, and yeah. Well, keep going. We'll answer the question.
Got it. Okay. I've retired from the military and a utility company, both paying a pension. I also have a service-connected disability income and $1 million in my IRA. My current investment is 60% in stocks, 40% in bonds with a Vanguard advisor. My question to you is, when I hang up my hat and leave work, should I switch to a conservative 60-40 bond stocks as Mr. Bogle and the Bogleheads have advised? I don't mind the risk, but just in case the market turns downward, I don't want to have to return to work again and recover from substantial market losses. I'm a fan. I've been watching and listening to you all for years. Appreciate that, Keith. Really enjoy the email. But so this is the age or the rule of 100 or the rule of 120, which I hope that Mr. Jack Bogle didn't come up with, because it's the worst thing you can possibly do. It's the stupidest thing I've ever heard of in my life.
I think I will say it this way. It's what you do when you have no other idea what to do and have done no financial planning and have given it no thought whatsoever.
And you have an IQ of 4.
It's probably better than nothing, but boy, this is not the gold standard. This is annuity salesmen came up with this to sell more fixed annuity products. Yeah, because as you get older, you got to go safer.
Yeah, you got to go safer, and then this is the safest investment that you can get into, and it's a fixed product. So, like red hat, green hat, or hot money, fast money, cold money, all that stupid.
You're 70. You have 70% in fixed, and I got just the product for you. I wouldn't be surprised.
Yeah, you got $1 million, Keith? Well, you need 70% in this fixed annuity. It's going to pay me a nice 7% commission. So, no, what you have to take a look at. So Keith, he's got a pension. He's got disability. He's got $1 million. He's going to have Social Security potentially. So it sounds like Keith is set up with his fixed income. So it's not 60-40. It's not your age. I mean, we have clients that are in their 90s that have millions that it's for their grandchildren. So you're 90 minus 100, so 10% in stocks, 90% in bonds, and it's for a kid that's, in his 20s. I mean, you would lose your license. That's really bad advice. So
yeah, I mean, the concept, the general concept, which is get a little bit more conservative as a general rule as you get older, is okay and sound. It's just that when you look at everybody's situation, everyone has a different answer because their circumstances are differently. We'll have people in their 40s that maybe all they should handle is 30% in the stock market, just because of a whole variety of things. Maybe they got a whole bunch of stock options, they got a whole bunch of money, they're risk adverse, and they don't need to take a risk to cover their lifestyle. Well, it has nothing to do with 100 minus 40, right?
Right.
Or 100 minus 60 or 100 minus 90. What happens when you get to 105? Then you have to have 105% bonds and
you got to give 5%. Yeah, you short the market, and you got to give 5% of your stuff to the Treasury.
Yeah, maybe that's it. Yeah.
So, and I like where he's going, because I think a lot of people might be hearing the same kind of bad advice. Here's a rule of thumb I think is better, Keith, is that it takes a little bit more work than just taking your age minus 100. You have to look at, okay, what are you spending? Let's say Keith is spending $60,000 a year, and maybe his pension and Social Security is paying him $40,000 a year, right? So you look at the shortfall. So if he's spending 60 and the shortfall is 40, he's going to be short $20,000, right? And in that case, he might want to go 10 years. Let's say he's a pretty conservative guy. He wants to be a little bit more conservative. So go 10 years in fixed income. So 10 years of let's say a fixed income of your income need. So if he needs $20,000 a year times 10 years would be $200,000. So in Keith's situation, he's got $1 million. So we might recommend an 80-20 portfolio, 80% stocks, 20% bonds, because it's very specific towards his goals.
Right. Yeah, and I think that's right. And the other way to look at it is you go through the same math and figure out, okay, 20,000 is what I need. What's my portfolio? $1 million. So I have a 2% draw rate, right? And then you can you add maybe 1% or more for inflation and add some for growth and taxes. And so maybe you need a 4 or 5% rate of return. And then you figure out a portfolio that's going to earn that rate of return. That's a little bit harder than what you just said, but both are appropriate measures. And that's why you get different answers for everybody, regardless of their age, because everyone's situation is different.
Right. I mean, if I'm going to sit at your kitchen table, Al, and ask you how much money you have and how old you are, all I got to do is put 100 minus your age and say, this is what you need, sir.
Yeah, and you need to pay me a bunch because I'm smart enough to know this formula.
Yeah, so here's your financial plan. All right, Tom from Chantilly, Virginia. I remember saying Chantilly, Virginia. Is this Tom a regular, or is he catching the
I think this is the second
wave?
time. I think this is the second time Tom has emailed us, maybe a third.
Or maybe he's, introducing our show to other people in his neighborhood. Joe, Big Al, and Andy, my wife is getting laid off in December, and I want to take advantage of the CARES Act COVID 401k withdrawal strategy. That would be a CRD, Tom, a coronavirus-related distribution. Based on your podcast, it's my understanding that we can take up to $100,000 out of our 401k, pay the tax over a 3-year period, and not incur the 10% penalty. My plan is just to put the money in a brokerage account and take advantage of the long-term tax diversification. Given that taxes will eventually go up, is there any benefit in paying the taxes all in 1 year? Depending on the outcome of the election, I could also consider paying in a 2-year period since it takes time for new administration to implement new policy. What are your thoughts? As always, thanks so much. Okay, well, if he can take advantage of the CRD, Al, so what that means is that he can take $100,000 out of a retirement account. You can pay that money back over a 3-year time period, or pay the tax over a 3-year time period. So $100,000, $33,000 of income would show up on the tax return each year for the next 3 years. So he's saying, you know what, maybe I don't do that. Maybe I just have the $100,000 show up on my tax return this year, and I'll bite the bullet and I'll pay the tax. Tom, look at your taxable income and find out how much room that you have in your current bracket is what I would do. So I would run a little bit of a tax projection to show, okay, well, maybe because someone had a coronavirus incident, so he got diagnosed, his wife did, she got furloughed, laid off, whatever. So their income is probably lower this year than previous years. So he needs to do a little bit of math to look at, all right, well, roughly what was my taxable income last year, and make some adjustments for this year of how much that's going to be reduced. Take a look at the top of whatever bracket, and if it's in a fairly low bracket, I'm seeing like 22%, maybe you do pay the tax this year. If it's higher than that, maybe you push it out over 3. What do you think, Al?
Yeah, I agree with that. And one thing you mentioned is maybe I'll do 2 years, and that's not an option. You can do it all in 1 year, or you can do it in 3. You're not allowed to pay the tax in 2 years. So those are your choices. And, when you think about changing tax rates, I mean, we know under current law, the tax rates will change in 2026 back to what they were pre-2018, which is about 3% more for each bracket, roughly, than where it was before. If you look at what Biden is talking about, he's basically talking about keeping the same brackets, unless you're in the highest bracket, maybe going up to 39.6 or something like that. That's when you're making more than 622,000. So I don't, and plus that would have to be a change that got through Congress and the Senate, which it seems these days unlikely for those kinds of things to happen. So I wouldn't worry too much about that. I mean, I think you're right, Joe. I think you look at the tax bracket. If you can accommodate it all in 1 year and want to do that, great. Otherwise, if you're in the same bracket each of the 3 years, I would just defer it over 3 years. Why pay tax earlier than you have to, considering the time value of money?
Yeah, without question. I think what the only caveat, right, is he's thinking if there's going to be a significant change in tax law,
Right.
So maybe the 22% tax bracket goes to something significantly higher where he could have paid it all at the 22% bracket versus, going into the 25. You pay, a third of it on the 22, and then the other 2 years is going to be something higher. So
Yeah, and you don't really have to decide until you file your return, which would be April 15th or even October 15th, right?
of next
The
year.
following year, right?
Yeah.
And but by then, I think there'll be a lot more clarity on what's going on. So I would kind of wait till there's more clarity before you come up with your strategy.
Very good. Very good. All right. Thanks a lot for the question.
Who's going to win the race for the White House? Will the next Congress be red or blue? Do elections even matter for financial markets? And are your taxes heading higher? Our Executive Vice President and Director of Research here at Pure Financial Advisors, Brian Perry, CFP, CFA, is in the middle of writing a series of blog posts on this very topic called Decision 2020, Your Money and Your Vote. You can read the first 3 installments right now in the podcast show notes, and be sure you're subscribed to the YMYW newsletter to get updates when Brian publishes the next 3 installments on taxes and building an election-proof portfolio. Click the link in the description of today's episode in your podcast app to go to the show notes, read the podcast transcript, access Brian's latest blog posts, subscribe to the newsletter, and send in your money questions.
Larry writes in somewhere near Columbus, Ohio. Hey, Andy, Big Al, and Joe. God, that's annoying. Love the show. Yours is one of the few podcasts in my rotation that I faithfully listen to every week. You are the car talk of personal finance, extremely informative while being incredibly entertaining. I have a question regarding when my wife and I begin to draw Social Security. I'm 58, she's 60. We both retired within the past year. We are considering waiting to age 70 before either of us draws Social Security. We are fortunate to have saved more than significant post and pre-tax savings from which we will draw to pay for living expenses until age 70 and beyond. My expected Social Security payment at 70 will be $3,000. My wife's is going to be $1,800, so $4,800 combined. We both are in good health and hope to live past the break-even point and maybe into our 90s. My question is, given that we can
Forestall. Hold off on.
Forestall in 7 years ago. Okay, drawing on Social Security until we are eligible for the maximum benefit. Should we necessarily do so? Okay. Is there any circumstance in which one of us might want to consider drawing earlier, or in which delaying for a larger benefit is not financially meaningful? Thanks for your opinion and insight. Okay, so he's saying, hey, just because we can afford to forestall our Social Security benefit, should we?
Yeah, that's what he asked.
And he's looking at this as an investment, Alan, not necessarily insurance. So we can answer this 2 ways. I guess the insurance ways, if you think you're going to live into your 90s, then forestall. Right? Because it's a guaranteed income stream that you're going to have for the rest of your life.
Well, I would say if you're both going to live into your 90s, which hopefully you do, then you both delay. If one of you, for some reason, has impaired life expectancy, I would have Larry at least then wait till age 70.
Because he's got the higher benefit.
He's got the higher benefit, and then maybe his spouse could then draw earlier, right? Because if one isn't going to make it till, let's say, 80, maybe that's 75, then you might as well get that other spousal income early, right? And then the whatever spouse survives the other one gets the higher benefit. So that could be a reason why you wouldn't do it both at age 70.
So, or you do this. You take it at 62, both of you, and then invest it. You don't need it. You have other assets, and then just be more aggressive with it. I mean, what's the goal, right? Is it like when I die, I'm on my deathbed, and I want to add up all the money that I got from Social Security. If I took it at 62 and invested it, took it at 67 or 70, right, and spent it. It depends on what you're trying to accomplish, right? If you look at it as an investment, you can run any assumption that you want, and probably taking it early at 62 and then using a fairly high expected rate of return would probably give you the highest amount of money. But there's no guarantees there. I guess there's no guarantees in life, right? We believe that if you push it out as long as you can, it's a guaranteed income source by the federal government, promising us that today. It has a fairly high probably, a probability of paying out versus getting maybe an 8 or 10 or 12% rate of return in the overall markets, right? So you just have to take a look at what risks you're willing to take.
Yeah, I think you said it right, Joe. The key is we kind of look at this as insurance. It's backed by the government. And by the way, say what you want about the government. Our government also controls the money supply. So they're going to make the payments, right? So could they change the rules? Maybe. And so there could be a concern about means testing. It's been discussed. There's nothing in the works right now, but that means testing would mean at a certain income level or certain asset level, maybe you don't get all your benefits. That's possible. There's nothing being discussed right now. And I actually, Joe, even if something like that happens, it will probably happen for someone probably younger than 50, wouldn't you say? I mean, it probably won't happen with the baby boomer generation, which
Right.
they're part of. So,
well,
yeah.
I mean, stranger things have happened because they changed the claiming, with the file and suspend and everything else. They grandfather just a short window of people. Usually they grandfather a lot larger group of people. But, I don't know. You look at this. I agree with you. If they got a large pension, will they means test it? Probably. It could happen. So I don't know. There's all sorts of things that I guess you could look at depending on how you want to look at the system.
Yeah, but I think the key is that it's like people look at this as break even, and when you pass away, who cares? Right?
Who cares? You're dead. No one's ever complained and saying, "Damn it,
I should have claimed it earlier.
I should have claimed early." Man, they're on their deathbed. Do you have any regrets? Yes. Should have claimed my Social Security benefits earlier. Damn it. Then they croak. We got one from Dean from Chicago, Alan. I enjoyed the combination of knowledge, honesty, and friendly banter that makes your podcast educational and entertaining. I'm getting mixed answers for the divorce spousal benefit from the SSA website. I was born November 1954. My ex-wife was born March 1953. We were married 24 years and have been divorced 17 years. Can I claim divorce spousal benefits? Or does the January 2nd, 1954 spousal rule prevent it? I'm born after January 2nd and she was born before January 2nd. I have not claimed Social Security yet, but my ex-wife was hoping to hold off on claiming SSA benefits till I turn 70 and get a monthly boost using the ex-wife's benefit. Currently, my Social Security benefits around $2,700, and hers is $1,900. Thank you for looking at my question. Well, thank you, Dean. So, Al, what he's looking at here is he wants to file a restricted application on his own benefit. He wants to file a spousal benefit on an ex-spouse's record and claim 50% of that benefit because he is full retirement age. And he wants to let his own benefit accrue the 8% delayed retirement credit until his age 70 and then turn his on. That's the gist of what I'm trying to understand from his question.
Yeah, that's what I get too. And unfortunately, I don't think, Dean, you're going to like the answer because there was a rule change, as you identified, on January 2nd, 1954. And this is right off the Social Security Administration website. I'll just kind of read a couple little blurbs here.
Well, the rule wasn't changed in 1954.
I'm sorry. It was changed recently. Yeah, thank you.
It affects 1954.
It affects people that were born before or after January 2nd, 1954. See, it was, 65 years ago. We're finally getting around to talking about it. Okay, let me start over. Whether you were born before or after January 2nd, 1954 makes a difference.
Right.
So if your ex-spouse was born before January 2nd, 1954, ex-spouse being you, Dean, and has already reached full retirement age and can choose, then they can choose to receive only the divorced spouse's benefit and delay receiving their own retirement benefit until a later date.
So if Dean was before, if Dean was born before 1954, January 2nd, 1954, he would be able to file the restricted application and let his accrue. But he was born after January 2nd, 1954, by a few months.
Yeah, by about 10, 11 months. And so now here's the second sentence. If your ex-spouse's birthday is January 2nd or 1954, again, being Dean, being the ex-spouse, or later, the option to take only one benefit at full retirement age no longer exists. You can take the spousal benefit, Joe, but then you're deemed to take your own benefit. So you can't get the delayed retirement credit is kind of what he's asking.
Right. He could try to take the spousal benefit now, but it's basically going to give him his own benefit. It's going to be the higher of the two.
That higher the two. That's right. So there's zero benefit. So if he wants to wait till 70, then wait till 70. But there's unfortunately no way to game the system on getting the spousal benefit. That's why they made that change, because it was a pretty generous rule. And at some point, the politicians felt that wasn't the intent of the rule.
So yeah, the old file and suspend. I mean, we used to do that quite a bit. It seems like it's changed quite a few years ago now. Man, time flies, right?
Yeah.
Wasn't that 2015 or something?
God, no, it was 1954 compared to now.
Yeah, that was even before I was born. How about that? And I'm finally getting around to it right now.
All right.
I was just going to say next week I'll get to 1955, maybe through 57.
I've got derails about Al, his wife Annie, and their cat coming up. You don't want to miss this. Your Money, Your Wealth is presented by Pure Financial Advisors. Click the Get an Assessment button in the podcast show notes at yourmoneyyourwealth.com or call 888-994-6257 to schedule your free financial assessment. That's 888-994-6257. Pure Financial Advisors is a registered investment advisor. This show does not intend to provide personalized investment advice through this broadcast and does not represent that the securities or services discussed are suitable for any investor. Investors are advised not to rely on any information contained in the broadcast in the process of making a full and informed investment decision.
Forestall.
Who
the hell says forestall?
That's the first time you've ever heard that word, isn't it, Joe?
Guaranteed. Guaranteed. I thought
that was a word probably during the probably like 1776 and in that era, I'm guessing.
Larry, are you like a professor of? Given that we can forestall drawing, I'm going to use that word at the barn on Friday night.
Yeah, see what kind of response you get.
Having my fifth beer.
But you have to say it like you know what it means. It's forestall, not forestall.
Whatever, I'm not.
We got this. We're in Hawaii right now. We got this cat that keeps showing up at our doorstep every morning, wanting milk.
Really?
And salmon.
And
you know why? Well,
how do you know it wants milk and salmon?
Because the first
that's what he's giving him.
The first day, that's what Annie gave him, and he keeps coming back.
Well,
so
of course.
Where's the salmon? She put out like Rice Krispies. You didn't like that.
I got used to salmon.
Sorry. Yeah, right.
What the hell? What do you guys have Rice Krispies for?
Breakfast, whatever. Why does anyone have Rice Krispies?
Oh my God.
What do you eat?
You go to the Clopine house just cover it full of salmon and Rice Krispies.
And milk and Rice Krispies. That's it. That's all we got.
The last time I've had Rice Krispies is like 30 years ago. I was like 5 years old.
Well, the truth is, I almost every single morning eat oatmeal, to be honest. So I don't know why we have Rice Krispies here.
Get the munchies there in Hawaii? Okay. All right, so Roger, we're back to him. All right. He's driving around the Altima, doesn't have a pet. Al's got a cat for you.
I got the cat needs somebody.
And Annie, you don't have to bend over. We're not on TV. This is just a podcast.
Oh, he said you don't have to bend over. We're not on TV. It's a radio podcast. But she'd been, I didn't even see.
Yeah, she's hiding
Yeah.
behind you.
You see
She's
the
grabbing
top of her,
yeah, she's
top of her
grabbing
head
something.
as she went in to grab something from the fridge.
Yeah.
Got it.
No.
I'm just thinking about what are we going to feed the cat? Because I think we're out of salmon.
I don't know.
Rice Krispies.
Yeah,
And-
Rice Krispies. There you go.
Well,
Well,
the cat didn't. I didn't know whether it's he or she, but he or she did not like the Rice Krispies. And we've already named the cat. The cat is named. You ready for this? Kitty.
Oh, brilliant.
wow, that's creative.
Very.
Very creative.
Yeah. Well, we're sitting in Hawaii, so you know it's kind of you just do what you need to do. Everything else is just it's free and easy, right? It's Kitty. I'm not going to think of like Dolores or some hard name. It's just Kitty.
Oh, Dolores.